Association of Financial Advisors of India, in association with Resurgent India Knowledge Series presents live webinar on Co-Lending Recast, Unpacking RBI's Co-Lending Arrangements Directions 2025.
Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers:
Mr. Sameer Mahajan, Chief Business Officer, DMI Housing Finance Private Limited. Mr. Vinod Kothari, Director, Vinod Kothari Consultants. Mr. Ankur Sharma, DGM Bank of Maharashtra. Mr. G. Ramesh Kumar, General Manager, NABARD. Mr. Abhishek Rathi, Business Head, Godrej Capital. Mr. Praveen Kinney, General Manager, Central Bank of India.
Yeah, good evening, friends. I would like to
Good evening,
welcome to good evening, everybody. So, I'm Ashish Agrawal. I'm from Resurgent India, and I'm the one of the founding member of Association of Financial Advisors of India, AFAI, which is the organizing body for this webinar. And it's an association for creating awareness about the various financial related topics among the finance professionals, either bankers or the other people in the financial field. And this body has organized one co-lending national summit in the month of November. It was a great, huge response from the industry. So keeping in mind, we have made a target that we'll update to the industry whatever is happening on the co-lending side, and we will organize such programs on regular basis so that we can invite industry bankers and the other people, professionals at one place and discuss on the various aspects of co-lending. So, friends, we have a very good panel today. If you see, we have senior bankers with us. We have NBFC business heads and finance heads. Then we have financial institution senior professional, and we have very senior to senior consultant or the advisor in the industry since last many years, and who is the encyclopedia on the securitization and co-lending. So it's a very good panel from the discussion point of view. And the today's webinar, we have invited people from the various backgrounds. So there are many industry captains from the NBFCs, the senior bankers, professionals, rating agencies, and even the private equity and VC funds, those have invested in the NBFC or those aspiring to invest in the NBFC companies also. So from the panel point of view or from the audience point of view, it's a good combination today where everybody is interested to understand, to know more about the developments which are there from the RBI side. So as you know that co-lending started on November 5, 2020, as per the RBI circular. Before that, there was a coordination circular, but there was no headway at that time. So after this RBI circular in November 2020, this co-lending has grown like anything. And as per the industry reports, it has reached to something around 1 lakh crore plus of the industry in terms of the partnerships between banks and NBFCs. Almost all the banks in the country have come out with the co-lending policy. They have spent a lot of time, lot of cost, even not banks, even NBFC for the technology integration, creating the separate department for that. Then the infrastructure, technology, all these areas. Last 5 years, lot has happened already. Many you see that many NBFCs have already been tied up, and they have seen the journey also. And this was growing very well. But on April 9th, RBI came out with a not master, it's a draft directions for the co-lending, for the observations and the suggestions and the recommendations from the public at large. Those are the stakeholders, so that RBI can listen the views of the industry. Whatever they want to do, they have already given the circular, but they want to do whether this is right, wrong, or what are the areas of concern, so that they can consider all these suggestions, and maybe some committee will decide which are the areas which need to be taken up in the final master circular for co-lending. So as it happens not in co-lending, but in every area, that there is a beginning, then there are roadblocks, and then when the roadblocks are get over, then you see that it is growing like anything actually. So I'm quite hopeful that this must the directions or the draft guidelines which are there. I think this will be helpful to the industry at a whole, as a whole, not the banks only, but the NBFCs also, and the ultimate borrower also. So it is in the good perspective from the RBI side. But today we are here to discuss on the various aspects of the draft directions, and what the industry is thinking, and what the other stakeholders are thinking about that, and what are our suggestions, so that we can collate all these suggestions, all these recommendations from the industry side, and submit to the regulator, or the ministry, or the other stakeholders for their consideration, so that the our voice, the today's discussion can reach to them, and there might be some areas which they can consider from the today's discussion, and which will be the success of the today's discussion actually. So I have prepared a small PPT which will just give the outlook of the areas which are covered in the RBI directions, draft directions, so that we can discuss on these areas, and take it forward this discussion. I would like to once again thank you to the all panel speakers for taking time from their busy schedule, and the audience also. We got very good response. More than 500 people have registered for the program. So I hope so. This will be beneficial for them from the learning point of view, and in the contribution also in the overall program also, and the suggestions might be very relevant for us also. So this is a comparative analysis of RBI co-lending framework of 2020 versus 2025 directions. Yeah, next slide. So, as you know that this circular was issued, or directions were issued on 9th April, and then we have time to submit our suggestions, or whatever the recommendations to the RBI by 12th of May 2025. So, roughly we have 12, 15 days, or 12 to 14 days for such recommendations or suggestions. So, although we are discussing here, although we are discussing here, sorry. So we are discussing here as a industry as a whole, but being your practitioners, NBFC or banks, you can also submit your segmentation and suggestion directly to RBI from your organization, which might help them to consider these suggestions also. So I was seeing that directions, the circular. So there are 12 key areas are there which they have covered, on which they have highlighted their recommendations or the directions. So if you see the applicability, the scope of applicability of co-lending. So earlier it was covered only on the priority sector lending. Now they have opened for the all type of loans, whether priority or non-priority. That's the one major area which has been covered in this in the directions. And you see that there is one more area also there which they have covered in the scope of applicability. This is, they have added the All India Financial Institutions as the co-lending partner. So this was not given earlier, but now they have added this also. So there are five or six six financial institutions are there in the country. So they will get benefit out of it, or they will be having the clear direction that they are also eligible for partnering with the other REs, regulated entities, for the co-lending tie-ups also. So like NAVA, RCDB, then the other institution, NFED and all, they can also partner for that actually. So this will help to the industry as a whole, because they are covering the non-PSL loans also, and the All India financial institutions are also covered. So these two key things will help in the applicability, or the eligible institutions or eligible loans will multiply the industry, the co-lending in future actually. So that's our observation. And the second area is the eligible partnerships. So earlier it was between banks and NBFC. It was clearly written in that circular. But here they have permitted to the any RE to RE co-lending. So this is another good part. Now the clear directions are there that the any RE can partner in co-lending, either junior, senior partner. So this is very good actually in terms of covering the all REs under one umbrella. So this is second observation of RBI. Next slide. So third concern area is the preferred model. So there are two models in the co-lending, CLM1 and CLM2. Earlier, these two models were applicable. Anybody can go for either or. But now they have uh, given the direction that it can be only one CLM model, which is CLM1. So this is one of the major concern area for all the stakeholders, and they are RBI is thinking that CLM2 guidelines are similar to DA, so it's better to go for DA rather than going for the CLM2 under co-lending model. And so there will be the co-lending which are under CLM2 as of today. It will shift to under the DA model now. So the DA volumes can increase going forward if the RBI is giving only CLM model after final circular in this co-lending. The fourth concern area is minimum share requirement. So if you see earlier, it was very clearly written that minimum share of the junior partners would be minimum 20%. Now they have not given any MRR requirement. It can be 100-0, it can be 50-50, or whatever combination is allowed, or whatever combination is decided by both the partners. So this is another, I think, good part which will, I think, definitely help to the industry. To some of the players, those are, I think, not willing to give this 20% the from their own uh, skin in the game, so that they can go at the 100-0 also, or they can go up to 50-50 also. So we'll discuss on that. We'll take the expert views also on that. And default loss guarantee, it was a DLG, it was not there in the earlier circular. Now they have allowed up to 5% DLG can be there by the junior partner or the other partner who is the sourcing partner for the other RE. So up to 5% DLG can be there. That is allowed in that actually. Next slide. Yeah, next slide. Loan sourcing and servicing. So uh, although it was the responsibility earlier of the other partner who was sourcing the loans, but now they have clearly written uh, that it should not be only a sourcing agent. There should be RE jointly fund loans with shared risk and revenue. So now this is more clear. But earlier it was the only NBFCs. They were the single point facing for the customers. But now I think they are saying that this would be jointly fund the loans also. That was earlier also, and share the risk and revenue. Then the interest rate determination. I think this is a gray area where everybody now putting their head that what will happen, because this is directly related to the revenue of the entities from the co-lending point of view. So interest rate earlier it was although all inclusive rate for the lenders, but under CLM 2, because the NBFCs were lending the loans to the borrower, and then they were going to the banks for the co-lending. So there was the spread which they were earning on the differential pricing to the borrower, and now they have given the concept of blended rate, and blended rate which is I think need to be discussed. So we will discuss in detail with our experts that how it will be decided and what will be the impact of it. And what we understand with that kind of clause or with that requirement, the ultimate borrower will get the advantage in terms of overall borrowing cost to them. So I think RBI has to think of that. They want to pass on the benefits of the co-lending to the ultimate borrower, which why not happening under co-lending model in the CLM2 in a proper manner actually. Asset classification. The earlier the both the partners were classifying the assets separately. Now this is a compulsory that this should be a mirror image for both the organizations. So if NBFC or the other RE is classified as SME or NPA, the same way the other partner, another partner should classify the portfolio. So there should be the real time classification of the portfolio, so that the borrower should not suffer because of that. The one partner is showing something, another partner is showing something actually. Next. So borrower disclosure. So now they have brought the concept of key fact statements, which will include all the information regarding interest rates, fees, or the other arrangement between both the REs. Earlier, it was just an intimation, it was not a detailed key fact statement, what we understand. And the RBI has put that also that if there is any change in the terms which have been given in the key fact statements, the both the parties should inform in a joint manner or maybe separately. This need to be decided to the borrower that these are the changes and will be applicable to the borrower. So and this required the consent of the borrower. This is something. I think this is one area which is very important to discuss and comment on that. Whether we need the borrower consent every time, on which are the areas where the borrower consent is required actually, because in every area you cannot go for taking the consent of the borrower, because what we have seen, once the borrower has taken the loan, he is least bothered about the changes and the other areas, unless until it is not impacting the overall repayments to the borrower actually. So this is an area which I think we'll discuss the today discussion with our expert speakers. What should be the area which should be covered or which should not be covered in that actually. Regulatory oversight. I think now there's a complete the comprehensive regulatory framework which RBI has provided or has asked to follow in the co-lending between both the REs, so that there should be a greater transparency and the consumer protection at the borrower end also. So next slide. I think these are the areas, major areas which have been covered in the overall guidelines of the direction from the RBI point of view. So this is something which we have tried to prepare from the circular, and now we have the time to speak with our panel speaker, esteemed speakers, for their understanding point of view and the key areas which are the concern areas the today's discussion. So I would like to once again welcome to the all the panel speakers. So we have Mr. Samir Mahajan, from Chief Business Officer from DMI. Then we have Mr. G. Ramesh Kumar, General Manager from NABARD. And then we have Mr. Vinod Kumar, Director, Vinod Kothari Consultants. Then we have Mr. Abhishek Rathi, Business Head from Godrej Capital. Then we have Ankur Sharma, who is from Bank of Maharashtra. He is the DGM, he is in charge of co-lending. And you are supposed to join Mr. Praveen Kini from Central Bank. I hope that he has not joined. I think shortly he will join, or he must be having some other issues. That's why he has not joined. We'll check from the they basically checked with Kini sir whether he is joining or not. So sir, now we have already discussed the concern areas. I would like to understand from all of you from the directions point of view. So, like the first area is the applicability, which in which there are two things are being covered. One is that the PSL, non-PSL. Earlier it was only PSL, and the covering of the other REs also. So if you have seen that they have covered the financial all India financial institutions, which were not earlier. So we have NABARD, Mr. Ramesh Kumar from NABARD, who is in charge of the refinancing and co-lending. So they are all India financial institutions. So Ramesh sir, one is that PSL, non-PSL, another is the inclusion of all India financial institutions. What is your views on that? Whether uh, this was required or this is beneficial to all the institutions, and this covering the PSL, non-PSL will also help to NABARD or the other financial institutions. So, Ramesh sir, over to you. Sir, you are on mute, sir. Sir, you are on mute. Ramesh sir, you are on mute.
Uh, Thank you, sir. You, in fact, covered entire very lucidly entire spectrum of the RBI guidelines. We only have to discuss the impact and other things. So I say that the earlier bank NBFC partnerships, it is restricted. Co-lending arrangement was restricted to bank NBFC partnerships and priority sector lending. Now requiring case-to-case approvals for non-PSL use cases. Now, this has actually curtailed the scalability and innovation potential of the model. So now that has been now this RBI is setting the stage by encouraging co-lending across a full spectrum of lenders and loans. And it is for wider financial inclusion, competitive pricing, and also resilient risk sharing mechanisms. So that will allow more and more financial inclusion, and also ultimate aim what RBI has felt is that though co-lending arrangement has come, as you all know, majority are under CLM 2 only. So now CLM 1 also will now curtailing the CLM 2, or now CLM 1, that is actual partnerships. Ultimately the ultimate beneficiary will be held, getting the benefit of the this interest rate and other things. So that is what the I understand from the uh, basically the co-lending draft guidelines circulated by RBI. So these will have a definite contractual arrangement specifying risk sharing, fee demarcation, borrower responsibilities, and also operational oversight.
So,
What is yes, sir.
Ramesh sir, sorry to interrupt you.
Yeah.
I think you very well covered. We would like to understand more from that point of view. The covering of all India financial institutions will definitely help to NABARD, because earlier I
Yes, sir.
think this was subject to approval and all.
Yeah, yes,
So
sir.
now it's a open guideline for
Yes,
everybody.
yes,
Another
sir.
is PSL, non-PSL. So as
Mm.
NABARD, it will make any difference for you that whether it's a PSL, non-PSL, both, or only PSL is there earlier, as earlier. This will
For
be
PSL, non-PSL, NABARD is mostly looking at the PSL guide portfolio only. Non-PSL co-lending we are not looking at. So we are looking at the PSL only. But definitely earlier we have to take a permission. All India Financial Institution like SIDBI has taken permission for co-lending from RBI case to case. Now it has come as a guideline. So it is very beneficial that all India financial institutions also can participate in co-lending program. For us, NABARD, and this will be up to the priority sector loans only.
okay. Got it. That's great, I think. So, so these are the poll which we are just running here actually, so that I'll request to all the people who are here actually in this discussion, they should do the polling from their understanding point of view, that this question which is there, whether the RBI should reconsider to discontinuing the discriminatory co-lending CLM2. So this will help to submit to RBI that after there are many people who were there actually, and out of that, some people have see, yeah, some people have said studied no, and some people are not very much concerned about it. So that it might help to RBI to decide whether they should discontinue or not discontinue. So I request all of you, please, uh, I think, give your vote here, actually, or give your comment here also, so that it will be helpful to all of us to submit to RBI the complete information. Yeah, so thank you, Ramesh sir, for giving your views on that, and what we can consider that inclusion of all India financial institutions will help to get more co-lending partnerships, and the agenda of NABARD is like agree and the SIDBI for MSME. So I think these are the specialized institutions in the country, and they have a lot of uh, funding from the government for the refinancing purposes also, and they are into direct lending also. So this the co-lending volumes may increase, and the other RE partners, if they will hook on with the institutions, they can get the agri lending also under co-lending, and the MSME lending in the big way, actually. So this is the conclusion which we think, but we'll discuss from other experts also. Now I'll come to Abhishek ji. Abhishek ji, you are part of a very large corporate group also, and the running the large NBFC also. So Abhishek ji, you see that there is one area which is now clarified by RBI, this NBFC to NBFC co-lending or RE to RE co-lending, actually. Earlier, we know that you were already involved into the co-lending with the NBFC, but I think it was not very clear whether it is allowed, not allowed. So what do you think? What will be the impact of it from the Godrej point of view, or overall industry also, and how the volume will increase if this will be there, and the other RE will follow that also.
Yeah. Thanks, Ashish ji, for
Yeah.
having me here. And I think, first of all, thanks to you for arranging this. I think this is a very crucial time of the year that these guidelines are expected to come down. And as an industry, I think it's a good forum for us to kind of discuss and debate. So, first of all, thanks for arranging this. So
Thank you,
from
sir.
our perspective, Ashiji, and to the forum, I think one thing that we've all seen across for some time now is that while there was no clear direction from RBI in terms of NBFC to NBFC co-lending or anything beyond bank to NBFC co-lending, I think the draft now gives us a lot of clarity in terms of accepting all REs to get into the partnership here. Now, what it is in essence does, and this is more from our perspective and what we've been discussing, is that earlier the limiting structure of co-lending between bank and NBFC had its own challenges. While there were use cases between NBFC to NBFC partnership, but I think just clearly stating it out gives a lot more transparency to the whole process. It just allows to REs to get into a more structured agreement, then calling it by different names. Some used to call it BLM, some used to call it CLM, or the names thereby. But the draft now clearly spells it out and gives as much clarity and transparency to the whole process. In essence, what it also does, according to me, is it democratizes the whole credit delivery piece more from customer experience standpoint. Considering what Rameshji also said in terms of allowing it for from PSL to non-PSL, and enabling the structure to allow all participants to get into a structured partnership, it just helps in the true sense of including or rather enhancing the financial inclusion, which is the core thought of RBI to kind of get into the co-lending world in the first place. It also reduces from an NBFC perspective. I mean, from an originator's perspective, it also reduces concentration risk to a large extent. That earlier it was largely concentrated to a few large banks to that extent. But now the ability of getting into partnership with maybe like-minded NBFCs or other regulated entities just allows the concentration risks to diversify. It also, in essence, will help in more innovation and product development from both sides. Because if there are more market participants in the piece, it just enables the ecosystem to thrive from the current levels to the next level, which is where I think the draft also put some emphasis on. In a nutshell, I think from our perspective, while we've been doing co-lending with NBFCs at Godrej as well, but just having that more clarity, transparency from the regulator opens up doors for more partnerships in this space. And fundamentally, it's more about getting collaboration between two NBFCs, structuring it through and helping the end customer is the way we look at it, that the draft kind of emphasizes on.
Great. So thank you so much. So you are good, excited now that this co-lending under RE to RE is now NBFC to NBFC allowed.
Yeah, and like I said, I mean, while there have been use cases, I mean, there have been multiple use cases of NBFC to NBFC co-lending, but in the true spirit of having it black and white from the regulators, and obviously puts in a lot more clarity, transparency for both participants to get into a structured deal.
Okay. I think this is because of that one thing which you have told that I think this will address the concentration risk area, because earlier it was between banks to NBFC. And
Yeah,
there may be more use cases where the NBFC understand the other NBFCs also, because they are in the same umbrella. So they can be more, I think, co-lending in a faster manner also, and the volumes can also increase. So this can be another thought process of RBI to allow this co-lending under RE to NBFC to NBFC also. Any
I
thought
would
on
tend
that,
to
sir?
believe that the pie has to expand. One thing that you, while in your introduction you did mention about model one, model two being being getting eliminated in true sense, is for a simple fact that it was eating away the share that DA or securitization was used to have. But having two different structures, I mean, DA securitization as a different structure and true co-lending as a different structure, just enables the pie to enhance. And that's where I think all of us should be excited about. Rather than having a piece of the same pie, it just helps the industry to enlarge the pie, have more different types of partnerships that enables the credit system to enhance in the country.
Okay, great. Thank you so much. Samir ji, you are running a housing finance company, a chief business officer, and you are in the more kind of mortgage loans actually. So, what do you think this model one? Because now model two, as per the directions, the RBI will come with the final guidelines, maybe stopped or maybe may not be allowed. So, what do you think this mortgage loans under co-lending model one, co-lending under model one, the mortgage loans, how feasible it is actually? Do you think that NBFCs and banks will come together and the whatever the USP of the NBFCs are there, the TET or the customer doorstep or the collection and all these things. So, or then the valuations or the LER, and so there lot of information documents are there, because till now we are not having online land records or the other things actually. So, from your point of view, will it be possible or not possible? And as a HFC, what are your views on that?
So, Ashish ji, thanks. I'm audible to everyone.
Yeah, you're audible.
So, Ashish ji, first of all, as I just loved what Abhishek said and my fellow panelists as well. First of all, thank you to you for this beautiful forum where we all have come together. And as I always say to you when we meet, there's a lot to learn from you. So, while you introduced everyone very nicely, I would like to appreciate you as well for this initiative and all that you bring to all of us on the table. Yeah, coming back to your query regarding method one. So I feel yes, it does have its share of challenges because method two was very simple. You build loans and then you sell it later on. Method one does have its set of challenges because I to make it truly successful, we'll have to do a lot of there's need to be a lot of synchronization between the larger partner and the smaller partner. But as I say this, out of my own experience in DMI HFC, we have already been doing it in method one with some of the players. One of two you have also helped us get hold of. and it has worked decently for us. Uh, yes, we need to innovate we need to innovate every day in terms of how can we, as you rightly said, legal, technical of the smaller NBFC and us, and how do we co-originate the loan at the same point of time. But as if you look at it from a totality, I think the universe which Abhishek also said becomes very big for us after this, because so I think it'll even out, and I think that it will take time, and but in the longer run, it'll smoothen out, and it will lead to more inclusion and more business coming down with the challenges, I'm sure. But as I gave you our example, हमने किया है कुछ players के साथ, and it has been doing well for us for the last 1 year, and we were doing method one only because method two wasn't allowed in those arrangements. So it has done well for us. So yes, a lot of synchronization, lot of, I think the both CTOs of both the companies will need to talk a lot and find ways and means. But I think there is a way around it.
So great. I think you have said one word is innovation. More innovation is required actually. So that's a very right word which you have told. But as you told that between your company and the other NBFC or HFC, you are doing because again because you said you have the same kind of umbrella. But I'm
Yeah.
talking about the bank to NBFCs. So we would like to take your suggestions that if suppose this is only model one tomorrow, and you are into mortgage loans and you are partnering with a bank. So what kind of challenges will be faced, and what are the suggestions which you want to give to the audience that these are five areas are there. If these can be considered in the co-lending, then the model one will be successful in the mortgage loans actually between bank to NBFC. If you can cover up these areas.
Between a bank to NBFC, if you're saying how to make the model one more successful,
More
lot
successful
of
in the mortgage loans from the
mortgage
debt point of
loans.
view.
Yeah, then probably while we are entering into an arrangement, there has to be proper coordination between both the players, as to be very clear on. So as we already do, that there has to be a very agreed policy and guidelines on what works for both the players. Because the challenge which you rightly brought out is that once it the practical challenge which happens is that if you look at it in detail, what will happen is an underwriter of a company A will approve a case, and then an underwriter of a company B will also approve the same case. So, and you can at times look at the same individual differently. So that's the challenge. To bridge this challenge, I think all that probably can be done is that there has to be a lot of meetings happening between the underwriters and the technical teams and the legal teams of both the companies. And before we try to scale up the business, we have to arrive at some very, very common grounds on the policy and how are we going to go about it in terms of the processing of the business, the legal, technical, and the credit part of it. And secondly, the technological innovation, which the integration between the two companies, there needs to be probably platforms and ways and means which we will need to find out. As I said, this has just happened because, to be very honest, most of what I know about co-lending is happening in a larger way in the method two. So method one now, when you have no option, people will find ways and means. So I think I don't have all the answers to your question. That
Okay.
what are the
No
three
issue.
or the five things?
I will make you simple. Actually, I make it simple for you. Like, what is the TAT which you have currently for disbursing loan to your customer without banking support in terms of co-lending? Suppose
Huh,
you got a
so
customer.
15. So you are saying from a lead to a dispersal, how much time does it take us?
Yeah.
Right? Or from a login to a dispersal, it takes us roughly about 22, 23, 24 days to give the check to
Okay.
the client on an average.
Okay. So in case of partnering with a bank, 24 days TAT is I think it is sufficient enough. I believe.
That is sufficient. The biggest challenge when we if you're if we when we partner with a larger bank and say probably a very large bank is the mindset of the people on the both sides of the table, and that is the most biggest challenge which I see. and how do we iron out that, and they understand us and we understand them. Because I have the experience of doing co-lending in method 1 when it started about 5 years back. I'll spare the name. It had its lot of challenges. Like, we were going to that bank and sitting there for about 1.5 hours, and so it didn't really work out. So the biggest challenge which I see is that the mindset of the players on the both sides has to be that we have to find solutions to it. So if you're saying कि एक केस को हम 22 दिन में करते हो तो वहां कितने में करेंगे, इट ऑल वो 22 दिन में हो जाएगा, बट उसमें चैलेंजेस जो लीगल टेक्निकल वैल्यूएशन और अंडरराइटिंग के हैं, अगर उसको हम स्मूदन आउट शुरू में ही कर दें व्हेंस द रिलेशनशिप स्टार्ट्स, so before starting a lot of brainstorming will have to happen amongst the teams.
So got it, got it. I think you're rightly so. So there are two areas. One is that intent of the both the partners. Another is that the areas which are the part of the both the organization. So you can sort out actually. I believe between both the organization intent is there. You can sort out all these issues. कि head क्या होगा. Now I would like to discuss, because I'm discussing in detail this part of the call. Model 1 and Model 2 is the major concern area in this entire circular actually. And you are the right person to give the answer for that, because you are not truly mortgage loans actually, and the question will come there only. So you see that the areas which are out of the ambit of both the partners, like you rightly told, the valuation, legal, there we are not having any control in our hand actually. The third parties are involved actually. The land records are not online. So from that, what are the areas which are out of the your ambit actually in terms of the within the organization? So we can understand these. Ankurji, there I'll come to Ankurji. He is a banker, so he will also cover up on that. As a banker, what they think actually.
जस्ट 2 cents ऑन इट, जो हमारे लिए इज वर्किंग प्रीटी वेल इज दैट, जैसे आपने टेक्निकल का बात किया, तो मान लो मैं आपके साथ आई एम टाइंग अप विद यू इन मेथड 1. सो व्हाट स्मार्टली वी कैन डू इज, say for example you have a vendor A and a vendor B, and then I have a vendor C and D. So I say okay, I approve vendor A and B on day 1. So आप ही का vendor मैं अगर approve कर देता हूँ, that takes one problem away from me, because you've been working with this vendor for 5 years, right? And you have your comfort, right? I approve your vendors. That's one problem solved. ऐसे मतलब, so these are the problems which we have been able to solve in the last 1.5 years. So legal जैसे हम करते हैं, like where we are the larger partner in DMI. So we उस जो partner से जो हम sign up ही कर रहे होते हैं, तो we tell that partner that this will be the legal, these two agencies. You please check them. Are you okay? So they said yes, they are okay. So the same agencies work for us and for them. तो legal technical वहां से थोड़ा बहुत सॉल्व हो जाता है. सबसे बड़ा चैलेंज जो है तो वो अंडरराइटिंग, कि मतलब एक अंडरराइटर करता है फिर दूसरा अंडरराइटर करता है, दोनों जहां दो एक्सपर्ट मिलते हैं वहां पे थोड़ा सा लगता है कि भाई क्या करना है, मतलब द हु इज द बिगर एक्सपर्ट. दैट्स द लिटिल बिट ऑफ अ चैलेंज, बट आई एम श्योर एट वंस वी आर डीलिंग एट दोस लेवल्स उसका सोल्यूशन
Okay.
निकल आता है. बट
So according to you, underwriting can be the concern area between banks and NBFC under the mortgage loan, because everybody has own interpretation, like
या
LTV and some other areas are there. So now Ankurji is here actually. Let us listen from the horse's mouth actually. Ankurji, you have listened Sameer ji also. So he said when the co-lending one will be there, two will not be there. So on the mortgage loan, these will be the concern areas. So if you can address from the banking point of view, what do you think under model one, keeping in mind your journey in co-lending space? And the another question is for you is the interest rate, blending of the interest rate actually, and the servicing fee. So practically as a bank, what are you thinking, and what will be the impact on the overall cost to the banks also, and the ultimate borrower? Will there be any benefit to the ultimate borrower also? So sir, over to you.
So first of all, I would like to thank Ashish ji for giving opportunity. So answer as like that. In the product approval stage itself, within a partnership, we can determine the what are the legal agencies, what are the valuation agencies, which are commonly onboarded for the arrangement. So there will be somewhat that will be going to impacted, and in view of the that there will be credit delivery will be somewhat as example in CLM2, once the NBFC gives the loan, then it gets reimbursement from our side. So there will be some, you can say, turnaround time will be on a higher side. Second thing, regarding blended interest rate, this was the major emphasis of the RBI, that the interest arbitrage which the NBFCs were enjoying. So they told that the benefit should go on to the end customer. So end customer will get the benefit, and NBFC can claim higher, you can say, service fee based on their OPEX, collection costs, and other budgets. And if the bank pays the, you can say, higher service fee, definitely it will be added in the, you can say, overall it will be added in the bank pricing. So ultimately, the end borrower will be benefited by the, you can say, more disclosure. For example, in this RBI draft guidelines, they have laid down the policies and procedures for the disclosure. What will be the annualized percentage rate in a particular co-lending arrangement? That will be disclosed to the borrower through the key fact statement also, and through the disclosure at their particular websites. So better disclosures is what RBI is looking for, and end customer should get the benefit out of the capital deployed by the banks in the co-lending, and NBFC should get the benefit from the refinance, and it will be more of the integration on lively basis. Systems and procedures will be interacting with each other to make that at the lowest level.
So Ankurji, this one thing which you were discussing with Sameer also, that there is a possibility the mortgage loan, the banks and NBFC will come together. There will not be any impact on the overall procedures or the process. It can done smoothly, maybe with something here and there. So that's good actually. Then it shows that both banks and NBFC are ready to adopt the co-lending model one. So that's the one conclusion which we can drive from here actually. And the other thing, the interest rate. I think this is another big issue also. So the RBI is thinking to give the benefit to the borrower of this partnership actually. But in true sense, there are two components. One is the interest rate, another is the servicing fee. So वो एक कहावत है अपने यहाँ की, कान इधर से पकड़ो या उधर से पकड़ो आपने, मतलब अभी एज ऑफ टुडे वी आर टेकिंग स्प्रेड ऑन द इंटरेस्ट on the model 2. Model 1, there will be some cost to the bank, then there will be some servicing fee. So the servicing fee, collection fee, or the sourcing fee, if it will be equal to that, whatever the spread is coming today, so how the ultimate borrower will get the advantage of it under this CLM1? Do you have any understanding on that? That there will be any standardization of that, or every partnership will be customized also according to the other partners' cost and everything? And then there is another component of GST on that actually. So currently, this is a spread where the GST is not involved. This is also a huge cost actually. So ultimately, कहते हैं ना कि वो जो भी है वो ultimately consumer को bear करना. So are we considering all these things, and do we think that at the end of the day, consumer will get the benefit out of it?
Sir, in the existing partnerships, we are taking that what is the we are stipulating to pass on to the end customer, that what will be the maximum rate which the you can say originator can charge. But in this scenario which the RBI has come in, they are telling that we have to get the weighted average of the interest rate. For example, banks charge to MSME an interest rate of 11%. So on bank's portion, 80%, let's say, whatever is the loan sharing ratio between the two, 80%, 11% will be charged, and 20% they can charge NBFC their rates. Okay. So accordingly, if 80-20, the weighted average will be charged from the end borrower. And in order to factor in the process that service fee, so we will going to lay some premium for the co-lending in our pricing matrix, so that we can disclose it well, and disclosures will be made by both the parties at their respective websites. What is the rate they are charging under their co-lending arrangement with the respective bankers or the originators, vice versa, both.
Okay, got it. Great. So thank you so much. I think out of these 12 issues, we have already covered 5, 6 issues here. Now, I would like to come to Vinod sir. Vinodji, as you are veteran in the regulatory side, you can decode this circular better than anybody. So I leave it to you to cover up from your perspective, which are the areas where you think that there should be a reconsideration by RBI so that all the participants, all the panel speakers can get this advantage also. So I think it's open field for you out of these 12 issues which are there. Your suggestions or the recommendation will be very helpful to all of us. So over to you, sir.
Thanks, Ashish ji. It's wonderful to be interacting with all the panelists here, and you've been able to pull together a very substantial and pertinent crowd to discuss this very important topic. Before I come to address the, potential areas for improvisation in the draft directions, let me just quickly first throw some of my views on how do I see this proposed change. Let's first understand that in the scheme of things that RBI is envisaging, there are three separate products. Co-lending is a separate product. Transfer of loan exposures, a so-called DA, is another product. And loan sourcing is the third product. Loan sourcing is one without any participation, just a sourcing of the loan. And I'm sure everyone understands that this draft directions not only includes provisions on co-lending, it talks about CLA co-lending arrangement as well as loan sourcing. Explicitly, it covers loan sourcing as well. Therefore, this will be a sort of unified, comprehensive piece on co-lending as well as loan sourcing. That's so loan sourcing without any participation. Therefore, the so-called 100-0 structure is not co-lending actually, it becomes a loan source, pure and simple loan sourcing. Other option is that we originate a loan, we nurture it, we season it, and on a cherry picking basis, somebody comes and buys the loan. The loan is already there. The loan has been created. The loan is nurtured. One can come and see. I take it if you like it. Cherry pick and take what you like. I have placed the loans on the table. You come and buy what you like. That's exactly what is referred to as transfer of loan exposures, for which, as everyone understands, from 2021, we have explicit directions on that. The so-called CLM2 was a sort of an exception to the TLE, and particularly the RBI had expressed its intent as well that this was being done to promote private sector lending. And therefore, that had a very limited purpose to promote PSL lending between banks and NBFCs. It came with a carve out that everything else in TLE directions would be applicable except for the minimum holding period. Therefore, the so-called CLM2 was always nothing but a TLE, and therefore now it's anyway, CLM2 has been removed from co-lending, therefore it's now sitting as a part of TLE. So TLE deals with all loan transfers. Loans have been originated with a minimum holding period. Somebody can come and see the performance of loan and buy it. That's TLE. As far as co-lending is concerned, there are three very strong positives with these directions. The three positives, number one, transparency and clarity. As I'm sure everyone has spoken earlier, that prior to this, we had guidelines for PSL co-lending. When it came to non-PSL co-lending, there was absolutely nothing. And as Mr. Abhishek Rathi mentioned, and Ashish ji, you are well aware of that, that when co-lending was happening in the marketplace, was it limited to PSL co-lending? Absolutely not. Over the last several years, actually, non-PSL co-lending was rampant. A lot of non-PSL co-lending was happening. Was it happening between banks and NBFCs? Once again, a lot of non-PSL co-lending was happening other than between banks and NBFCs. There were lots of co-lending between NBFCs and NBFCs as well. And I don't need to once again get into who is doing, but everyone knows that everyone was doing non-PSL co-lending between NBFCs as well. However, there was no framework. Now, the problem is when we have no rule book and people still get into business, they always have this lurking fear, हम जो कर रहे हैं वो ठीक कर रहे हैं कि नहीं, कल को आर्मी आके ऑब्जेक्शन तो नहीं करेगा. So the biggest advantage is now we have a completely transparent framework. Whatever we propose to do is covered by a well set rule book. So you're within the rule book, you're okay. If you're not within the rule book, then well, the RBI will obviously object. So transparency is the biggest positive. The second very important positive is flexibility. These directions give an absolute flexibility. So earlier we talked about a 20-80 structure. Some people were doing whatever lesser 10-90. Some people went to the extent of 199, etc. etc. Now there is a complete flexibility. There is absolutely no defined minimum share of the co-lender. The co-lenders may decide from 0.01 to whatever percent you want. Absolutely no share that is making it zero would make it a case of loan sourcing, but you can decide the share. Will people decide 1090 or will people decide 595 or people will stick to 2080? That's left to the marketplace. To my mind, that's actually less important. The more important part is that the directions now explicitly and clearly permit risk sharing of the sourcing, risk sharing by the sourcing partner by providing a DLG. Now it's a different thing that DLG was being provided earlier as well. There were explicitly no explicit framework, but people were doing arrangements whereby the risk was disproportionately split between the two co-lenders. Now the directions laid clearly that you can do disproportional risk sharing. There can be a 5% FLDG by the sourcing partner. Beyond the 5% FLDG, there'll be no other subordination or no other credit support of any kind. So be within the 5% FLDG framework. That's all you can do. Therefore, what does not matter is the extent of risk, extent of loan. Whether you take 5 or 10 or 15 or 20 doesn't matter. What matters is that the sourcing partner may provide risk support to the extent of the first loss piece of 5%. Now, some people might say, after all, the 5%, yes, it's not large enough. We can take 20% share. This we're talking about 5% only. Please do understand the 5% is on first loss basis. So as anyone who understands structured finance would also appreciate that the moment the scope of the portfolio size widens, as the scope of the portfolio piece widens, that 5% becomes more and more significant. For the protected party, that is for the party which is seeking protection, larger the denominator over which that 5% share will be computed, the better it becomes. So 5% can be quite a lot, and for most portfolios, accepting some very weak transactions, like, I mean, I wouldn't like to name transactions though, but accepting some very, very weak transactions, 5% is still a very good share of risk that the co-lender may take. So in my view, three very significant positives. Number one, explicitly permitting risk protection, rendering a complete flexibility on the extent of share of the two partners. And of course, biggest positive is transparency. Ashish ji's pointed question was, what are the flags that one can flag to RBI and say, well, here you are, probably not being perfectly, practical or easy. I think basically two areas I can think of. I can probably think of more if we think further, but at least two things come up front of mind. First, NPA treatment dictated by the treatment of the other partner. Now, this to my mind is completely counterintuitive. See, different people might have different reasons to tag a loan as non-performing. For example, I'm a co-lender, but I also have a separate facility to same borrower. As an NBFC, I might have another facility going with the same borrower, which might have become non-performing. Because of that, this particular loan, which is perfectly going okay, is also classified as NPA. Why would it affect the other co-lender? Why would what is happening to my other facility should impact the other co-lender? That's a completely unreasonable part. In any case, it is not intuitive for a co-lender to go asking, भैया आप बताओ आपकी books में क्या treatment चल रहा है? आप NPA है कि performing चल रहा है? It does not make sense for me to keep asking the other guy. And particularly because lots of NBFCs have co-lending arrangements with lots of lenders. In fact, most banks here in this room as well, people will have probably co-lending with several NBFCs. So go asking everyone what is the current NPA status of the loan, and thereby that loan becomes NPA in my books, because of which other loans to same borrower also become NPA in my books. That is not making sense in my view. So that's one issue which needs to be resolved. Second issue, which is quite practical, and I think there needs to be a very practical solution to the so-called credit bureau filing. This is actually becoming a nightmare. Now, what the RBI expects is that for every loan, there is a credit bureau reporting. And if there are two co-lenders, both of them report to the credit bureau. Well, after all, interface with the borrower is maintained by one co-lender. So one co-lender files it for both. To my mind, I'm not sure what purpose will be better served by making both the co-lenders file it. Because both filing operationally, there's a duplication of work. After all, it's the same facility. Servicing data is available with the originating co-lender. He has the borrower interface. He's the one who's interacting with the borrower. He's got the loan records. He's the one who's actually carrying out collections. So why can't he file it for both? Why do you need the filing to be done by both the co-lenders? I mean, this reporting to credit bureau is actually anyway an operational challenge. And I think the RBI is now taking it to little extreme level because it's expecting for each facility by each lender, there should be credit bureau reporting. So it's becoming such an operational hassle. These are the 2 points that I would have wanted to raise, Ashish, but if there are other points, I'll be more than happy to address. I think
Very
I've
well said, sir.
exhausted the time that was available to me,
Yes,
Ashish,
yes,
but
you.
quick questions.
Thank
Yeah,
you.
sure.
No, so thank you so much. I'll open the floor for the audience also. They can ask any question if they think that I mean, this is relevant from the topic point of view. So I think there are some questions already there in the Q&A. What is the meaning of for sourcing arrangement in co-lending definition? So this is something which somebody has asked, Mr. Singh has asked actually, Gajendra Singh. So if anybody can take this question, what is the meaning of for sourcing arrangement in co-lending definition? So under co-lending definition, what is the sourcing arrangement actually? So I believe he is trying to understand the sourcing arrangement between both the partners. So I think the both the partners are not responsible for sourcing. I think only
If
one partner.
I
Yeah,
can
please,
take
sir.
it up, either the
Yeah.
two co-lenders can rely on a third-party loan sourcing agent. Sourcing is something that's already happening. Loan sourcing is something which is already happening. So both co-lenders may source it from a third party, or one of them may be sourcing for both. And Ashish, as you were saying that the sourcing and servicing party may separately charge servicing fees. That also now becomes quite clear from the RBI's draft directions. So a 100-0 structure will be taken as pure loan sourcing, where I don't have a share in the loan at all. In that case, I need not be a regulated entity. I can be a non-regulated entity as well, because it's a simple case of outsourcing. And non-RE can also be a loan sourcing agent. But as far as co-lending is concerned, very clearly, both the co-lenders have to be regulated entities.
Okay. Samir, you want to say something?
No. I was just wondering why would somebody go for 100-0? विनोद जी, what's the
Good
point?
question.
Co-lending में तो उससे
That's
अच्छा तो मैं
this.
DSA ही बन जाऊंगा, तो मेरे को 5%
That's loan
FLT.
source. That's loan
Yeah.
sourcing.
So does
Here as well, you can give 5% FLTs. In pure loan sourcing as well.
yeah.
Now, that's another very important point, that earlier FLDG was restricted to digital lending only. Now these guidelines extend FLDG to non-digital loans as well, provided the party giving the guarantee is a sourcing agent, B is a regulated entity itself. So if the party giving the guarantee is a regulated entity may give FLDG even for non-digital lending if the arrangement falls within the so-called CLA. In other words, it has to be co-lending arrangement, not purely loan sourcing. If it's a co-lending arrangement, non-digital lending, the party giving the guarantee is a regulated entity itself. It may provide 5% FLDG too. So that actually extends the scope of FLDG arrangements as well.
Great. तो सर इसमें एक क्वेश्चन और आता है कि so there can be a co-lending between three partners. So sourcing partner, then the co-lending RE, then all three can come together in that co-lending agreement. So
Sure.
is it
So
possible?
पहली बात तो there is no limit on number of co-lenders. It can be 2, 3, it can be several. At the same time, if the third entity is merely a sourcing entity, it hasn't got a share in the loan at all. In that case, it's purely a loan sourcing. It's not a co-lender. The co-lending arrangement, CLA, is defined where the two lenders are jointly lending. That would mean the loan has to have some share. It may be minimal share though, but it has to have some share of the co-lenders. If the third entity is not lending at all, just sourcing only, then the third entity is nothing but a sourcing agent.
So again, sir, sorry to ask again this question. You see that as we were discussing, 100-0 is also allowed. So between RE to RE, the co-lending can be in the form of 100-0. So there is no stake of the other RE, who is a sourcing partner or the collection underwriting partner.
So Ashish, in our view, 100-0 is nothing but loan sourcing. It's CLA, the co-lending arrangement itself, is defined to mean where there is a share. It's has to be a pre-agreed proportion to fund. You can see the definition of co-lending arrangement. It talks about pre-agreed proportion of the loan. The loan funds have to come from both. So 100-0 is not a case of CLA at all. 100-0 becomes a case of loan sourcing. It would be covered by these directions, but not CLA. It would be loan sourcing.
There can be three REs. One is a NBFC which is having infrastructure for loan sourcing. This is RE also. And another NBFC which is good in the collections or maybe the servicing of the loans. And third bank is there which is having the money also. This is the funding partner. So all three can come together. And who will give FLDG to whom actually? Because now all are allowed to take the FLDG actually. So this is not very clear because the sourcing partner will say they will not take any stake. They can source the loan, but they are RE. So another person will say that I'm just hypothetical discussing the situation because this will come. Now I think RBI have not also thought of about this also, but this situation can arrive and this can impact the entire co-lending model also. So in that case, this first sourcing partner will give the FLD to the second partner, which is underwriting and collection, and the second co-lending partner will give the FLD to third partner. How it will happen actually? Because everybody want to, yeah, sir, sorry. Everybody would like to save themselves. Everybody want to, yeah.
See, देखिए पहली बात तो ये कि one partner which is involved only in collections. Thinking of a guarantee coming from a person who is involved only in collections, I mean, does not prima facie look appropriate, but however, that may be the commercial agreement between the parties. So issue basically is that under this draft framework, FLDG may be given by an RE which is a part of a CLA. So it has to be number one RE, it has to be regulated entity. Number two, it has to be part of a CLA. CLA meaning CLA is defined to mean where there is a sharing of a loan. So that would mean unless party number one and party number two were also involved as co-lenders, they might have some minimal share, 1%, 0.5%, jo bhi share ho. If they have some share in the loan, then they may provide FLDG. But remember that the aggregate FLDG by both of them should not exceed 5%. 5% is the total amount of FLDG, even if given by more than one guarantor. But that's the aggregate level. So in order for either of them to give a guarantee, they must have some share in the loan, which means they must both be regulated entities themselves.
Okay. Got it.
So, Ashish ji, why would somebody want to become a ये arrangement में? I would rather not become a DSA. मतलब why would I go for 100-0? 5% क्यों दूंगा मैं FLDG बैंक को? मैं DSA बन जाऊंगा बैंक का. मतलब what business sense does it make for me
You are
to?
right. You are right. So these are the areas which need to be discussed and deliberated. So one is that the cost aspect, the FLDG, GST, all these areas are there which will come in the discussion, and every partner will see that whether this is feasible for them or not actually. So from the operational point of view, this is okay, but from the I think economics point of view, it is very important. So being you are there and Abhishek ji is there, this FLDG model, will it work other than we are having 20% minimum stake in the loan? That time there was a more skin in the game actually, rather than 5% in the overall FLDG model actually. So what is the thought? So but I think that RBI should come again that this should be 80-20, not the 100-0. This is the major change which they should bring in the direction. So they should reconsider 80-20. This FLDG will not work very well, and it might impact the entire arrangement also. So I think over to all the speakers also, just for the discussion point of view. Ankur ji also can contribute to that. As a banker, what he think also, and Samir ji and Ramesh ji and Abhishek ji.
Yeah, so I just had a point here, Ashish ji and Samir also. I think where it might merit having an FLDG along with having an 80-20 on an individual loan structure is from a simple perspective that 80-20 is at a loan structure level. When we talk about 5% FLDG, it is at the gross portfolio level. Now, because Model 1 has its own challenges of operational inefficiencies that both the entities will have to obviously overcome over a period of time. having a small comfort of risk coverage being provided by the originator eases out some part of operational challenges to some extent, because 80/20 is at a loan level, 5% is at a portfolio level. So fundamental difference is, I would still be, as an originator, if I were to look at it, I would still want to make some part of my balance sheet through a 20% share, by offering maybe 5% FLDG over and above, to ease out on credit policy guardrails that the two NBFCs, or a bank or NBFC, would want to get into there. And just to Samir, on your point of why would I not then want to become a DSA, I think it's more on from, if there is a inherent need of building own book plus offering FLDG to cover for some inefficiencies in the process part, is my understanding why a NBFC or an originator would be open for a 80/20 plus a 5%, because 5% eventually just adds on to your liability account as an additional contingent liability, but it eases out a lot of process inefficiencies, is what my understanding is.
Right. No, I was saying 100-0, not 80/20. 80/20 तो समझ आया, मेरी बुक बन रही है, पर 100 में तो मेरी बुक नहीं बन रही ना। जो 100-0 का क्लॉज रखा है, उस पे मेरा व्यू था कि भाई मैं वो क्यों करूंगा, मतलब इफ आई एम एनबीएफसी, आई लाइक टू बिल्ड माय ओन बुक। 20/80 आई अंडरस्टैंड।
So I think it's okay. Look, this is one of the area which is, I think, very important to discuss, and Ankurji is also there, because I had this view. Although I am not the NBFC and bank, but we are advising to NBFC. So you see, for an NBFC, because they are NBFC, you can ask anything. You can ask 20% also. You will ask 5% also. So ultimately, and then you are saying the GST also, servicing fee also, this will be curtailed also. So why is any partner will be interested for this kind of co-lending model? Whether you want to grow this co-lending model, or you want to slow down this model actually. But ultimately, you are saying that both the partner have to underwrite, they have to do the KYC. Then why the penalty to the one partner, the FLDG should be given up? Because you see that there's a psyche and the behavior of the larger partner. If you are a larger party, you always think that RBI allowed 5%, so you'll put up that condition that, and anybody who is lack of capital, or maybe they want to do co-lending, they will give it actually. But at the end of the day, if you see, this is not a true partnership where one partner is giving FLDG and both of you are originating, basically underwriting the same loan actually together, and then you are disbursing to the borrower. So I think this 5% FLDG will not be the right way of co-lending actually.
Very, very
You
valid
see,
point.
you see that
This
consortium lending, all of you are bankers and all. It's not like that the consortium leader is asking from the other consortium partner to give the 5% or 10% or 2% guarantee of FLDG, so that they should be saved tomorrow because they are the leader in the deal actually. So
Ashish ji, मेरे को, I hope I'm not interrupting you, but the very important
yeah,
thing I
please,
want
no,
to
no,
ask,
please, yeah.
very important thing I want to ask everyone, especially the panelists, if we have an answer to that. I think the most important thing is is it what one of the fellow panelists said that कि 100 रुपए आए तो 20 रुपीज में आप अपना से फॉर एग्जांपल 12% यू कैन चार्ज, एंड जो मेरा 80 रुपीज है उस पर आप 9% चार्ज करो, जो मेरा कॉस्ट जो मैं आपके साथ कर रहा हूँ. Is it going to be actually like this, or is it under debate discussion? Because if it is going to be exactly like this, then I see some, I don't know how profitable does this model remain. If somebody knows about it, somebody said on this call के ऐसे होगा कि 100 रुपीज में से 20 पे तो आप अपना रेट चार्ज करो, और वो एंड मनी विच आई एम गिविंग टू यू एट 80 रुपीज से 9%, तो उस पर आप क्लाइंट से 9 ही लोगे और वेटेड एवरेज रेट ले लो. तो फिर तो does anybody know about this or any clarity on this?
Yeah, Ankurji, I think can cover on this. I think whatever. Ankurji, are you there?
सर अंकुर जी ने बोला था.
I think, sir,
exactly.
RBI.
Yeah. Yes, sir.
Yeah, Ankurji, sorry.
I think RBI intention is that getting a ultimate lender getting a competitive price or competitive rate. On
The
that
borrower,
point,
you mean?
that means the minor partner will be restricted to he can give his origination expenses or whatever costing, OPEX वगैरह दे देगा, but you have to give a combined rate. There won't be much scope as earlier we have in CLM2 also. That scope won't be there here. Both of them have to give a common rate kind of thing to the ultimate borrower, and they can charge whoever is there origination and affects other expenses which are to be defined as per the industry practice or something. That what I understand here. The other
And yes,
others
sir.
can
Yes, sir.
yeah,
So,
I
Ankur ji,
understand only
I
this.
think everybody is looking towards you.
Maybe that's what I understand, and definitely that's that 100 in case of 100, it may not be very much beneficial to share the FLDG. I agree on that point. That maybe need to be deliberated more on that, because at least that means at least 20%, even 10% is there if you are giving some FLDG or so, that we can understand. But 100 with FLDG 5% and restricting yourself to OPEX and all, maybe the partner will be at receiving end.
Yeah.
No, you're right. This is a question which I have raised actually in this forum, that what are your views actually? Because they cannot be two things together actually. This your
Yes, yes.
contribution in the overall loan and the FLDG also. So, Ankurji, would you? I think Samirji has asked about something, that this blending of the
Regarding
rate.
FLDG, in the morning also I have made it clear that FLDG, they stipulate that FLDG is eminent to be given in case of co-lending. Previously, it was for the digitally sourced loan. So they have stated that it is mutatis mutandis for the digital loan in the co-lending. So we need to see clarity on that part. That was my first point. Second, interest rate, it needs to be weighted average. It is explicitly written in the point number 15 of the circular that the interest rate which I am charging for my on book exposure, that only I need to pass on the 80% of the loan sharing ratio percentage to the ultimate borrower under the co-lending arrangement with any of the originator NBFC or any other regulated entity, as ever the case may be. So point number 15 itself, if we read now, it explicitly tells what I have told.
Okay.
Ankurji, you being an expert, so you feel this is like, I will obviously put my head to it, but do you feel that it remains profitable for a smaller entity to then go into this?
So
वो पैसा
profitability, we have to re-engineer our costing proposition so that it is beneficial for both. We have to increase our interest rate, and you have to charge your service fee. In You have to compensate your service fee, although it will not be a full compensation of the arbitrage which NBFCs were enjoying earlier, but we have to definitely compensate.
सर एक मेरे को बात
And
बताओ, आई माइट बी नॉट मेकिंग सेंस बट आई जस्ट वांट टू आस्क यू दिस। मान लो मेरी कॉस्ट ऑफ फंड्स 12% है, ठीक है, एजम्पशन, राइट? तो मैं 20 रुपए 12% पे दूंगा, और जो उसने 80 रुपए दिए है वो कितने पे दूंगा, और फिर वेटेड एवरेज रेट जब
नहीं,
निकालूंगा।
आप 50% ले लीजिए, 50 ले लीजिए। 50% उनका शेयर है, 50 आपका है। 20% पे उन्होंने दिया, आपने दिया, 10% उन्होंने दिया। 15% का एवरेज कॉस्ट आ गया एक तरीके से बोरोवर के लिए। आपने
हाँ,
अगर टू मेक इट सिंपल, so in that case, you are lending to the borrower at 15%, where the bank is earning 10% on 80%. You are earning 20% on 20% actually.
ओके।
In that case, you are getting 20%. Your capital cost of borrowing cost will be 10%. So on 20%, you are getting 10%,
हम्म।
and you will get the servicing fee or the sourcing fee, whatever maybe, which will be decided between you and bank, which will be subject to GST. This is our
यस।
understanding. And then you have to give 5% FLDG, because what will happen? This is subject to negotiation. Every bank will ask now that we will start with that only, that we need 5% FLDG, because they will see the behavioral of the portfolio, that 2%, suppose there is a NPA in the books, they'll say that minimum 2% FLDG is required. then they will approve in the committee. So practically, in that case, the banks are very safe because they are getting this 2 to 5% FLDG, whatever is there, 20% skin is in the game also. So, and the operational cost
I
also, there
think
will be negotiation on that. So I'm sorry for that. So this is one area we should, I think, consider in our discussion, and we'll take it. Although that, as per the forum, we have discussed that FLDG is not the right, I think, way of going in this co-lending model. This would be they should brought back the 2080 minimum, this thing, or they can give the flexibility, maybe 1090 also, if they want to make it more less contribution of NBFC. But the FLDG part should be, removed from that. This recommendation I would like to submit. Well, this is my the thought process, but all of you are agree on that.
yeah. FLDG also, and also Ashish, a bit of clarity on the pricing, because वो रेट क्या हमारा निकल के आएगा क्लाइंट के लिए. मेरा जो कॉस्ट ऑफ फंड्स, तो चलो मतलब मेरे कॉस्ट ऑफ फंड से नीचे अगर क्लाइंट को लोन देना पड़ा तो मैं उसमें इंटरेस्टेड होऊंगा ही नहीं ना. मतलब व्हाई वुड आई लेंड एट बिलो माय कॉस्ट ऑफ फंड्स.
तो वो नहीं होगा सर. वो तो क्या है कि जो सर्विसिंग फी है आपका, वो
हाँ,
दैट विल बी
उसका अगर
एलिजिबल
कुछ,
ऑपरेशनल फी. वो तो डेफिनेटली इट विल बी एडेड इन द कॉस्ट, की फैक्ट शीट में आपको देना भी है कि व्हाट इज द अरेंजमेंट बिटवीन यू एंड द बैंक.
या प्लीज इस पे रिप्रेजेंटेशन दिया गया कि ये जो ये रेट वाला फैक्टर है, ये कैसे, हमें फॉर्मूला बताइए कि व्हाट इज द एग्जैक्ट फॉर्मूला. किसी कंपनी का ओपेक्स 4 है, किसी का 3 है, किसी का 5 है, तो कोई एक फॉर्मूला होगा ना कि ये रेट को लेंडिंग में मिलेगा. दैट ऑल्सो क्लैरिटी इफ यू कैन सीक फ्रॉम द रेगुलेटर, इट विल हेल्प अस ऑल.
ठीक है, वी विल कवर दैट आल्सो. Ankur ji, from your point of view as a banker, would you like any this thing which we can cover in the suggestions?
Sir, my
Maybe some
suggestion is like that, for, you can say, lower ticket size loan, we can recommend to regulator for continuation of that CLM2 up to 20 lakhs or 15 lakhs,
Very
because
good.
they need to be delivered immediately. And the if we have a common product, so there are less chances of deviation, and it gives a good portfolio, and ultimate borrower will be benefited by giving them the, you can say, benefit that RBI is more worried about the maximum rate of interest which the NBFC or the other players charge. We can give them, they can lay down the guideline that the maximum rate within this ambit they can charge based on their apex and capex, and disclosure they have to mention. So for smaller loans, which the borrower is less price sensitive, he wants more access to the credit. He is not bothered about the pricing. He wants credit timely so that it will favorably impact the GDP of the country, and the, you can say, he will be a customer. It will bring customer delight also. For bigger loans, price sensitive customer, this model CLM1 will go, and we have to upgrade ourselves technically, and you can say on resources front to deliver and cater to this co-lending circular.
Sir, very good suggestion, sir. I think they can rationalize the CLM2 in terms of the small loans, and so that the small borrowers will not be impacted by this new guidelines actually. So we definitely will cover. This is a very, very good suggestion. I think this will be helpful. Abhishek ji, would you like to comment on anything from your side? Because NBFC, a larger NBFC, you are doing co-lending between NBFC to NBFC also. So from that point of view, any point which you would like to cover?
So I think broadly, Ashish, most points have been covered over the course of last 1.5 hour. But I think just from operational efficiency, to improve operational efficiency between REs on more specifically model one perspective, I think some representation on reportings, while we had spoken about it, I think Vinodji also touched upon this. How do we ensure that one, reportings are not mismatched? Plus, I think operationally, how do we control inefficiencies in reporting from customer standpoint? Because today what is happening also is that between REs, we need to match pause balances. We need to ensure that DPDs are matched between REs on a daily basis, and reported to the CICs to that extent. If there is a gap in that, it kind of leads to a bad customer experience at the end of the day. So how do we ensure that? Because if the onus lies on either the originator or the balance sheet provider, I think it just helps the process overall from all reporting perspective. If there can be a representation, happy to hear thoughts from other panelists as well. That how can we improve on operational inefficiencies that creeps in when we talk about Model 1. I think one reason of Model 1 not getting picked up is because of the same operational inefficiencies that the model has. If there can be a clarity or representation around that, I think that should help all of us in this.
Great. So I think thank you so much for taking this question also. Uh, I think we have covered a lot, although it cannot be covered in 1 hour or 1.5 hours actually. But I think we have tried to dig out whatever the key questions are, the key challenges are there, or key recommendations are there. So I would like to, I think, sum up and close the session here. So I would like to thank you to all the panel speakers for joining with us. They have taken their valuable time for this webinar, and uh, I think this is very, very helpful to all of us. And uh, I will like to thank you to the people who have joined from the different part of the country, from different industry, different segments also, and they have made it more interactive by way of asking questions. Although I'm sorry that we could not take all the questions, but some of the questions which were there in the Q&A, I think, which have been covered in the discussion, so I'm not taking it again and again. But it is really great that you have participated in big number. We were seeing, I think, 120 number were here actually, and then the other people are there on the YouTube and the other channels also. So I hope that will be 400 people who have joined us actually. So thank you so much, audience, for the people who have joined with us in this program, and your participation is very, very helpful to us. And I would like to thank you to the Resurgent India team, the AFAI team rather, along with the Resurgent India team, for organizing this program and making it so successful, and bringing us to all at one place and discussing on this important topic. And I hope that you will organize such more programs also in the future, and from the industry point of view. And I would like to thank you specifically to the Preeti and the Devans and the other team members, and the Devesh and the Ankur and other people who are part of the team actually. And we will try to make some recommendation paper for RBI with our experts, and we'll send to all the panel speakers for your, I think, vetting, so that there should not be anything which we have not covered should go to the RBI. Once we will say okay, then we will submit to RBI. The deadline is something around, we like to submit before the end of this week actually. So maybe we'll send you this white paper by maybe tomorrow or maximum day after tomorrow. Until Friday, we would like to get all the suggestions, and then we'll submit to it actually, so that at least our voice would go there actually. And once again, I would like to thank you. And there are many suggestions which have come, like this Ankurji has told this 20 lakh, up to 20 lakh rupee loans would be in the CLM2. Then the FLDG should not be the criteria for the co-lending actually. And the operational inefficiency which Abhishekji has told actually. So all these things we will cover up in our white paper. And let's see that how the RBI will take it forward. And soon we will get the RBI circular also on this co-lending. But I hope so that whatever RBI will do, they will do it the benefit of all the stakeholders. Thank you once again. Thank you all for joining with us. Thank you. Thank you, everybody.
Thank you, Ashishji. Thanks,
Thank you,
everyone.
sir.
Thank you.
Thanks.
Thank you,
Thank
sir.
you, sir. Thank you. Thank
Bye,
you,
everyone.
Ankurji. Thank you.
Take care.
Thank you.
Thanks,
Thank
man.
you. Thank you, Sandeep.
Bye.
Okay. Thank you. Bye.